The UBS head of equity strategy just posted a report saying they expect the S&P 500, an index representing the US stock market, to fall at least 10% within a month. According to UBS, market conditions have gotten worse over the last 2 weeks, deteriorating to the worst conditions year to date. In fact, they believe the market is the most fragile in 6 years, and that any small problem, like weak economic data, could trigger a larger sell-off in the stock market. With recession headlines appearing across pretty much all media outlets over the last few months, and an increasing number of banks beginning to express caution on markets, it's easy for investors to get caught in the panic and act irrationally. So in this video, we are going to show you exactly why UBS is turning cautious while also providing the necessary context to avoid irrational decision-making. Rebecca Cheong, the head of UBS equity strategy, sent out a note to clients named Market Internal Weekly, and in it, she expressed her bearish view on the market for the next 2 months, citing quite clearly, "I expect the S&P 500 could drop by 10% from its peak within a month and by 15% within 2 months. She used this chart to support her case. It is the 2-month recovery score of the stock market, and it just hit the lowest point in 6 years. Both of these readings occurred in 2018 during periods of market volatility, and this right here was in March of 2020 during the large stock market decline we witnessed as a result of the pandemic. When we take a look at exactly what that corresponds to on a price chart of the S&P 500, we see that all 3 of these moments do correspond to periods of wild swings on the S&P 500. In all of these instances, the stock market did drop by 10%. But the big question is whether this 2-month recovery score actually predicts anything about the market, or whether it just states that the market is going through a period of volatility. Because the reality is that the stock market already experienced a 10% correction in August. Indeed, the 2 low points that this 2-month recovery score witnessed in 2018 occurred in February and December. Both of these coincided with bottoms in the market and did not predict anything about the future. This score basically tracks how well the market recovers from losses during the day. When the score is high, it means the market is bouncing back and showing strength. But when the score is low, like it is now, the market is weak and struggling to recover. So it's a way to gauge selling pressure in the market over time. So basically, UBS is saying that selling pressure in the market right now is very elevated, and we would only need to see the score stay at these same levels for the market to decline further. If the score improves, it could mean that selling pressure is calming down and that stocks are ready to resume higher. UBS also showed this chart in their report. It might look complicated, but it basically shows the inflows and outflows of UBS clients in and out of the stock market. And when we look at the Z-score, which shows us how far these inflows and outflows are from the norm, we see that there is definitely a lot more selling than buying that's been happening over the last 3 months. This shows us UBS clients have not been buying the dip. They've been using opportunities to sell stocks. Now, again, this doesn't predict what they'll be doing in the future. It just tells us that there are a lot of nervous investors in the market right now, and nervous investors means a volatile market. So for now, it seems that UBS isn't really giving data that predicts much about the future behavior of the market. The charts we've looked at so far basically say, hey, the market is volatile, and if volatility continues, stocks could go down. But they didn't stop there. UBS is predicting that corporate stock buybacks are about to decline. This is when a company buys back its stock. This is another chart that they included in their report, which shows us corporate buybacks over time. Corporate buybacks are when companies buy their own stocks. And in 3 weeks, companies will no longer be allowed to buy back their own shares as they prepare for earnings reports. And UBS estimates that corporate buybacks are going to begin plummeting heading into November. They argue this will make the market more vulnerable during this period of time. UBS recommends going short on IWM, XLF, and HYG as hedges against this vulnerability. Going short means betting against. Now, a hedge means that this is for clients that currently have exposure to the stock market, but want to protect themselves against volatility. Instead of selling their stocks, UBS believes going short on these instruments is a good way to hedge against the vulnerability. Let's break down why. IWM represents smaller companies in the Russell 2000 index. The average size of the company in IWM is about $1.7 billion. By comparison, companies in the S&P have a market cap of about $33 billion on average. UBS likes this hedge because something called the put-call ratio is low. This ratio measures how many bearish put options versus bullish call options are being traded. In theory, when the ratio is low, it suggests there is less downside protection, making IWM more vulnerable to a drop. In practice, when we look at the price action of IWM, we see that some low readings did lead to declines in the small cap index, like here in late 2018 or here in late 2021. But some low put call readings were actually followed by upside on IWM. UBS is betting on market volatility to continue, and for IWM to do something like in 2018 and 2021. They also recommend shorting XLF, an ETF that tracks the financial sector. UBS has what they call a dynamic sector score, and the financial sector currently has the worst rank out of all of the stock market sectors. According to UBS, that means financials are vulnerable to more downside. They mentioned that financials have just reached overextended levels, with 96% of stocks in the financial sector trending above their 50-day moving average. This is something that we've only seen a handful of times over the last couple of years. They argue this means financial stocks have limited upside. Indeed, quite a lot of these overextended readings did mark local peaks in XLF's price and were followed by quite significant corrections. But in late 2023, we have a counterexample where this level of overextension on XLF was followed by even more strength in the months that followed. Nonetheless, UBS believes that XLF is a shorting opportunity today, as these stocks are coming off overextended levels. Finally, UBS proposes shorting HYG, which focuses on high-yield bonds. These are also called junk bonds because they are considered to be high-risk investments and vulnerable to volatility. UBS sees HYG as being too high today relative to the volatility of the market, and we can see that clearly with the gap between HYG and the VIX, the volatility index of the S&P 500, that has been inverted on this chart. They believe that the corporate bond market is likely to catch down to where volatility is currently trading. Of course, one could make the case for volatility to catch up to where the bond market is. Remember, these strategies are based on historical data and current market conditions. No one can predict the future, so staying flexible and informed is key. The next few months are going to be important. We will be watching the Fed's decisions, the labor market data, and how major banks adjust their forecasts.